this trade war sort of began last year. Oh, trade wars are easy to win. It's going to be short-lived.
Yeah.
How long do you think this thing could go on?
I mean, clearly this doesn't end anytime soon, and I think here's the bigger fear. I think if you consider it almost seems like there's sort of two distinct camps within the Trump administration. One is the Peter Navarro camp, and the other is the Steve Mnuchin camp. And our sense is that
Navarro's winning.
Our sense is that he's definitely winning, and that
China hawk.
Yeah, and that actually it's beyond China. That he has a sort of a laundry list of countries that he would actually like to sort of have these conversations with. So our thinking is if Trump does win, that this will sort of punctuate his second 4 years.
What is
where
winning?
It's like,
how do we define? Because you heard Eunice's report.
Think you do.
If the president wants to ratchet up pressure on China and increase tariffs on China to force them to the table, if Eunice's reporting is correct, and it usually is, China's moving away. They're doing the exact opposite of what so it's both sides. It's like a couple.
Yeah.
Somebody's got to apologize,
yes,
but they're not. And eventually they're going to head to divorce.
No, and I think that's part of the problem. And again, that's our fear. It's if the Peter Navarro camp wins this battle between Mnuchin and Navarro, that this will be a problem. I think from a confidence perspective, and let's be clear, the reason why ISM and all these regional and these other regional PMIs are performing so poorly is exactly because of this, right? I mean, this is the thing that has really brought the Fed to the table.
All that really, we'll get to the Fed in a second, but I think all that really matters is the U.S. consumer reaction. Let's say the tariffs go into effect September 1st. Right now, the tariffs, a lot of people are confused by them. Most of the tariffs are on industrial goods, steel pipe, stuff like that, stuff we don't buy, but the stuff we buy is made from. This round would be on the stuff we buy, the flat panel TV, the iPhone, the Sony PlayStation console. Would a 10% jump in consumer prices destroy consumer spending and thus the American economy?
So there's a couple of ways of breaking this down. And so what we did initially was when we a year and a half ago, which is crazy that's been going on for a year and a half. But a year and a half ago, when we thought that these tariffs were going to be part of the landscape, we went through the effort of trying to understand what the worst case scenario would be from a U.S. economic perspective.
Is this it?
Well, so it's
because the economy is pretty good right now.
Oh yeah, so it's funny how it's playing out. We created this worst case scenario, thinking it would never play out, but in fact it sort of is. So what we did, and I'll be very brief, but what we basically did was we said, okay, let's assume that the U.S. consumer absorbs the full brunt of the tariff.
That 10% is passed on. The retailers eat nothing. Supply chain eats nothing. Something that costs $30 is now $33.
Exactly. And what we further assumed was that everything that we import from China gets hit with a 25% tariff. So again, we were really punitive in our analysis. When you go through that effort, what you see is that the actual economic impact would be about 0.5% of growth. So if you're chugging along at a 2.5% pace, then you'll immediately go down to 2%. Now, there's a lot of caveats to that. One of the caveats is, that's in a sort of a first order world. But there's all these second order effects, like what happens to the supply chain, and et cetera, et cetera. So that's your starting point for the conversation, is a 0.5% of growth. Again, in the worst case scenario.
Okay, and by the way, you talk about second derivative impacts. Coming up at the end of the show, we talk about shale boom, the oil and gas boom. Oil fell $7 yesterday. Some of these stocks are down 20% in a week. If we see massive job losses in the Permian Basin because of this, that's a second derivative impact where a million people that have good jobs now have no job.
Yeah, for sure. Now, it's funny that you use that example because we actually had a scenario like that sort of play out, right, in 2015, where we saw the energy complex really get hit really hard. And despite the fact that that impact bled right into the manufacturing space. Manufacturing was in recession in 2015. U.S. economic activity continued to chug along. I mean, I just think, again, using that specific example.
Can the Fed save us? Do they cut rates again in September because of this? And would a 0.5% cut in the Fed funds rate entice the consumer to stay in the market, even if consumer prices go up 10%?
So the short answer is no. The Fed actually can't. This has nothing to do with the Fed. Monetary policy can't blunt the blow of this.
It has everything to do with the Fed. Come on. The day after the Fed disappointed the president, this tweet comes out. They got to be related.
Listen, I'll say it again. monetary policy can do little to blunt the blow of what is ultimately a presidential policy. So I think it keeps the Fed engaged. I don't think there's any question about that. But I don't think that it's going to sort of change the narrative from an economic perspective. If manufacturing is going to slip into a recession because of this, it's still going to slip into a recession, despite the fact that the Fed is lowering rates. It's not a low rate problem. It's a policy problem.
It is if you're a real estate developer, I guess, who's now in the White House.